Hello, it's Modern Investing on Pod TV. My name is Sasha Starr, and today's guests are Dr. Milan Somberg. Welcome to the show, Milan.
Delighted to be here. Thank you for inviting me.
And Jim Eat from Eat Foundation. Welcome to the show, Jim.
Thank you. It's a pleasure.
And hopefully, we will have some special guests today for our show. As soon as they will be in the studio, I'd like to uh, get them into the show, introduce them. In the meantime, today is Wednesday. It looks like more green than red. And so it's kind of a not spectacular day, but nothing wrong with that either. Except one stock. It's AMD.
Yes.
It's a horrible. You know what? I'm furious of what happened in the 2 days prior to the report. The stock was flying. It was making 100% a day. It was like the only stocks that people would discuss and talk about it. And then on earnings, which were not that bad at all.
So.
It was okay. They didn't exceed. Okay,
Right.
from here, the guidance was maybe a lot. But to tank from 169, okay, it closed to 166, and it went all the way down. It's trading today 151. It's a crime. There's a crime happening. Where is the police? What's happening?
Well, I think part of it was that Ernst & Young resigned from working with the firm. That's the auditing company, a very famous company. So I think people just go, whoa, that must mean bad news. And I think that what happened to AMD just bled into other semiconductor stocks, including NVIDIA.
NVIDIA went down as well. Not that much, but still.
Yeah.
It did.
It's
in
just,
sympathy.
People, they aren't looking at NVIDIA's earnings potential now. They're just running because they're scared because something happened to AMD and they think it might happen to the others. But no, it's very specific to AMD. The auditor resigned. And
I promise to make a case against picking stocks.
Yes.
That's shocking.
Go ahead. Let's do it. Okay, make your case, Jim. Okay, I already sold. NVIDIA just sold everything else. Now I'm clean.
NVIDIA's going to be fine. Well, the Taiwan Semiconductor, Marvel, they're all going to be fine.
But Jim, listen, you know better. Jim, but you know better that if you compare NVIDIA and AMD, let's see, if NVIDIA it's a 5-star stock, AMD I would say it's 3-star stock. Nothing more than that, because they don't have a niche that they they exceed whatever Intel is doing. Already Intel is in the dust. NVIDIA though is different animals. They're just so much ahead of everybody else, including AMD. There is nothing could be done. Okay, they're creating their niche markets a little bit here, a little bit there, but they don't have a moat. It is, I remember a few months ago, one stock analyst, he said that AMD is a wonderful company, but they haven't had their NVIDIA days yet.
Yes,
that's ahead of them. So they have to see.
You talked about the stars to a stock, the number of stars that it gets. Who issues these stars? Who issues? But I'll say this: unless it's issued by Morningstar, you cannot trust any of them. Morningstar is independent. The other ones are all in the pocket of somebody.
I have nothing against Morningstar, and actually I'm using their star system.
I did.
They're okay. Listen, I found they're a little bit evasive sometimes when they're presenting stock, and it's obvious if they want to not to be wrong many times over and over, they have to be very, very subdued and very careful about their estimations. So, but actually, it's one of the best, if not the best, company in that respect. But they're not very good for momentum investors.
And the other thing that NVIDIA is good for its future, I think, is that Alphabet, which is the parent company of Microsoft, reported great earnings, and their investment in AI is just going to be continuing not only continuing but increasing. And I don't think NVIDIA tells you who their customers are, but I think it's a well-known secret that Microsoft is and will continue to buy what NVIDIA is selling.
All
So
of them. The Google had very good report, unexpected.
yes, this bodes well for the AI industry in general. So that's
Yeah, Google. Today, I think today after market we will have Meta reporting. Okay, yesterday was Reddit. You know what? A week ago, I was thinking about Reddit stock, and just didn't pay enough attention to that, and now I have to pay for it.
Well, woulda, coulda, shoulda, but it's not one of my favorites. But that's beyond my area of expertise, so I don't indulge in those types of things.
However, Jim, I think we have to listen now to Milan and his lecture about not buying individual stocks.
Well, I recently wrote an article titled "Mistakes Are Practice Shots, or They Should Be." For instance, I went to return a defective product to Walmart, and Walmart is very good for accepting returns for all sorts of reasons, but I didn't have a receipt, so they wouldn't take it back. So that was a mistake. And what did I learn from that mistake? I learned that I need to keep a receipt from Walmart anytime I buy there until I am sure that I'm going to keep the device I get from them. So that was a mistake I made, and I learned something from it. Now, what investor has not made mistakes in stock selection and market timing? For instance, has there ever been an investor who bought a stock that didn't decline? You bought a stock that declined, think of Nortel and think of Pennsylvania Central Railroad and so on. There are many of them.
I miss Nortel, so I cannot.
Okay, well, so what does an investor learn from that mistake? Another one is market timing. Say, for instance, an initial public offering. People who know a lot more about the security are selling to people who know nothing about it. And after 3 years, the average return on what was an IPO was minus 18%, with not a single positive one after 3 years. So that's a mistake in timing. And the first example, Nortel and Pennsylvania Central Railroad, are mistakes in picking stocks. What does that tell you? That tells you shouldn't pick stocks. Stay away from picking stocks because there is rules-based investing and judgment-based investing. Rules are always right. Let me just round them out very quickly. Our rules are save. If you don't save, the other 5 don't matter. Number 2 is do it yourself. Number 3 is buy the American economy as a whole, no picking stocks. The next one, number 4, is no market timing, buy and hold. The 5th one is adjust for when your asset allocation is thrown off by market movement. And the 6th one is avoid complexity. If you can't explain an investment to a 10-year-old, get away from it. Those are the 6 rules. They always work. Judgment-based investing, which is picking stocks, is wrong much of the time, as much as 50%. Would you drive a car knowing that there's a 50% chance of an accident? Well, that's what people are doing when they pick a stock. They're buying it from somebody who's selling it because it doesn't like it most of the time. Not all the time, but most of the time. So both can't be right. So the idea that what we learn from making mistakes is don't buy securities, individual security, buy the American market as a whole. And the other one is don't try to time market, but buy and hold. And so it's as simple as that, unbelievable as it might seem. That's all that you need to do to equal the strongest economy in the last 200 years. I rest my case.
And if you have 4 more rules, you can put them in stone. But no, I totally agree with you. And especially if you're not interested in investing, you don't want to follow the market closely, stocks closely. This is what Milan is suggesting is a very smart way to make money in the market. So no question about that. Sasha and I feel like we can do better, and we may be egocentric, but our track records have been reinforcing our egos.
Uh,
No, well, my case is very simple. If you are talking about all American market, you obviously mean S&P 500. And I have a data in the last 5 years, 7 stocks grossly outperformed all the rest. And in fact, if you eject the 7 stocks and you will say S&P 500, now you have S&P 493. Okay, so what did S&P 493 did in the last 5 years? I'm afraid it would be in minus territory. So in fact, you not only you will not make any money, you will actually lose money. So for 5 years, instead of being invested in Magnificent Seven and make 200, 300, 500%, you will lose 10, 20, 50% on holding 493 stocks. And in my right mind, I hope, I, I have to wrestle to convince myself you buy all American market. Get away from this Magnificent Seven. It's a garbage. Just throw them away. Okay, you already make 500%. Enough for you. Now go back to 493 stocks and lose money. Now you are investing in all American market. Bravo, Sasha. Bravo, Sasha. Oh, you lost some money. Hey, nothing. Okay. It's
well, of all the things I've lost, I miss my mind the most.
Actually, it's a good punishment. Let's see if the punishment is, let's see, for 6 months or maybe even a year, you are not allowed to buy any American stock. You have to buy S&P 493 stocks. That's your punishment. Once you do for 6 months or even better, 12 months, then you're okay.
I don't think there's an index for that one.
To your Magnificent Seven stuff. Shaquille, welcome to the show. How are you doing today?
Well, I was doing okay until I heard that I wasn't going to be allowed to buy American stock. So I don't know what I missed out about. I feel like I'm about to get a lot poorer.
No, we'll just slap a tariff on you.
Why in US they wouldn't make a law that individual investors are not allowed to buy individual stocks? Only mutual funds, ETFs, and of course S&P 500. Milan, would you proponent this law?
No, not mutual funds. ETFs, yes, not mutual funds. Mutual funds are connected with all sorts of expenses.
Okay.
The
so
owners,
let's ban individual stocks and mutual funds as well, right?
If we stopped people from buying individual stocks, they would be better off, unquestionably. Most investors are losers. The people here, with the possible exception of me, are brilliant investors. And that does not apply to the average investor. The average investor fails to equal the market. Equaling the market is something that can be taught to a high school student in less than 5 minutes, in 3 minutes.
I suggest something. When you said that most of investors are losers, I would say not just investors, most people are losers. Most of the people are losers. Why would you concentrate on investors? So investors are the stupidest people. All other people, they're not really losers. They're okay here and there. But investors, 90% of investors are losers. It's so hard for me to accept it, but maybe I have to. Jim, what do you think?
Well, I would not say that. I think we have people that are disciplined and informed and can do well in the market. And we have people that listen to the talking heads and buy what is recommended to them, or they hear the latest and greatest rumor and they invest that way. And that tends to be a losing strategy in the long run. And I think those people can be, they're not investing from a position of strength. And so they're following. And I think you want to try to stay ahead of the news, inform yourself and stick to what you know. And if you do that, follow a disciplined approach, you can do well and this is something that I've stuck to for 30 years, and it seems to have paid off. But I'll defer to Shaq, who's a superior investor in many ways, and he also, I think, thinks that he can do better than the market. I think.
Okay, this is a great punishment for Shaq. For 1 year, he can do nothing but investing in S&P 500. That's your punishment for next year.
Well, can I at least split the S&P 500 and I do some other? I can do the mini contracts again. I've got to do something. I'll do some index arbitrage. So
Okay, once a month.
So Jimmy's comments about the talking heads. It's just because Jim is so jealous and envious of the great Jim Cramer, who's out there on his show giving all these great stocks.
Yes, I'm green with envy.
Look, I'll say this, not to be pedantic, but I think there is a slight difference. Sasha's frozen with quite a.
He's frozen in a good spot.
That's so distracting now. I'll say that I think actually.
But you know,
I'll say actually, I would say I'm not an investor, actually. And I would say that as an investor, I'm terrible. I think that most investors, if you're specifically sort of specified by the definition of what an investor is, will probably do okay because they're investing over a long time horizon. I'm a trader, and that's why my returns are so high. You know, I'm used to taking a position and being out of that position on the same day, or the same week or the same month. I get pretty annoyed. And I beat myself up a bit and go, oh, I got this position so wrong if I'm hanging on to it for 3 months or 6 months, unless I specifically wanted to do that, but that's fairly rare. And that's why my returns are so high, is because I'm coming in and out of the market. Most people aren't doing that because you're not doing it as a job. If I was to actually trade the markets, or if I was going to invest in the markets, I really wouldn't want to be tying my money up for years at a time. I'd be looking at something and going, well, what do I think the 12-month or 2-year outlook looks like? The Australian dollar versus the Canadian dollar. When I went to Canada in 2016, one Australian dollar was buying $1.10 Canadian. Now it's buying 85 cents. Is there an argument that the weakness in the Australian economy overall is going to turn around and that conditions could change a bit and perhaps the Australian dollar will gain a bit against the Canadian? Cool. Okay, well, let's put a position on that and let's watch that ride out for the next couple of years. And if I'm wrong, it's okay because I can just hang on to it forever. And I've got to pay the interest rate differential, but I can hang on to this position. That sort of thing. And I don't think many people look at it like that.
Shaquille, you are an exceptional trader in that you are making money. There are evidence-based papers, scientifically based papers showing that most traders are losers. You're not. You're exceptional. That doesn't apply.
One of the worst things that happened was the day trader phenomena. Many people.
Yeah.
I think. Sorry.
Read this book.
I think that one of the issues with day traders is they get caught up in a couple of things. One, they get caught up in the idea that you can make money every single day. You can't. The reason why I have to hang on to my positions sometimes is because I didn't make the profit that I wanted to make on the day, and I don't want to give the position up because I only ever enter a position. If I want to trade a position for the day, I'm only going to trade that position if I know that I'm comfortable to hold that position for 3 months or 6 months or whatever, right? So that's the first thing. The second thing is that what people do is they fall into the notion of, hey, like I say to people here, hey, why would you go and buy the stock at $100 if you can buy the $90 call for $10, right? But you're only tying up $10.
Right. Yeah.
So the person goes, well, that means that I could actually type $100 to have 10 times the position size. And you've got to kind of sit down with them and go, look, please understand that if you take 100 options at $100 a share, your position is worth $10,000. You've tied up $1,000. The reason that's important is because people will start to take positions. And I've seen people with, a $50,000 account and they've got, 500 options in Tesla at $1,000, $500 a strike price and stuff like that. And I'm like, whoa, dude, like you've got a position that notionally is worth millions of dollars. If you get it right, hey, that's fantastic. You're going to have a supersized return, but you're probably not. right? Because you don't understand the derivative you're using. You don't understand theta decay and all that sort of stuff. So what you're going to end up with is you're going to end up blowing your account. And FX was great for this back in the cowboy days because they used to give people 1,000 to 1 leverage. That's 1 pip. For 1 pip, you double your account or you're done. I mean, it's this sort of stuff. So I think it's a lot of inexperience. I wouldn't support people not being able to trade individual stocks because you're never going to learn how to actually trade otherwise.
Exactly. I had to pay my dues.
A very reliable way to make money. History shows that it's been a reliable, it's returned 60% annually for over 100 years, is to buy covered calls on SPY, that's on the American economy, sell covered calls on SPY and take the premium. And your expiry date is the same day that you place the order. First thing in the morning, expiry same day at the end of the day. And then you keep taking the premiums, the income premiums, and keep doing that until you're assigned. Then you're in cash. Once you're in cash, you're now in a position to sell cash covered puts. And you keep taking the premiums there until you're assigned. And now you own SPY again, allowing you to...
Which is forbidden to do in Canada. In Canada, you cannot sell on the registered account the cash covered puts.
True, no, that's true.
However, but that's okay. Milan, I don't want to rain on your parade, though. I know. I refuse to even think about it. But I'm thinking more and more about, in a way, I'd like to demystify the concept of S&P 500 because all what it is, it's a collection of top 500 stocks, but they are still stocks. Stock number 1, number 2, number 3, number 495, 496, 500. There are 500 stocks. So your theory is that, of course, in 500 stocks, there will be winners, there will be losers, and there will be a majority probably will stay the same. So essentially, you are trying to, because you are buying a lot of losers, as we know in S&P 500. So you are using the top S&P stocks, such as Magnificent Seven, to save your face and money as well from all this horrible majority of S&P. Well, not 493, maybe 393, but nevertheless, majority of stocks which will do at the best nothing, and most cases will go down. So your theory is that the beauty of S&P 500, the way you present it, and the way probably that's what it is, that essentially you are cutting off losers or neutralizing losers, you're neutralizing winners, and you stay with the mass of sort of a gray area, which are some will go a little bit higher, some will go a little bit, and through this selling covered calls every day, every month, every hour and a half. So you're fun and you're making money actually on these little calls here and there, but there are no premiums. Look at the premiums of NVIDIA. What are you trying to make in S&P 500?
Give me a chance to respond.
Yes, please.
First of all, you're quite right about the fact that Canadians cannot sell cash secure puts in registered accounts. But if we open a margin account, we can do it there. Why not? I wrote a letter to our Minister of Finance about that just recently, and she responded in a very positive way, suggesting that yes, that ought to be possible in Canada too, as it is in the States. I'm not sure about Australia, but if we open
it's definitely possible here.
Yeah, we can do it if we open a margin account. Now, take a look at the strongest economy in the last couple of 100 years, the U.S. economy. Walk down the main street of any town, and in that town, the banks are making money on the main street, or any street, the banks are making money, and some professionals, like let's say lawyers and doctors and dentists, so almost everybody else there is...
Gynecologists are making good money.
Who is?
gynecologists and proctologists.
Oh, yeah. So the rest are mom and pop operations that are all losing money. Most restaurants are struggling, are losing money. Somebody who's selling gifts, somebody who's selling women's clothing stores, most of them are losing money. So that would apply to every town in North America, and yet we have the strongest economy in history. So we have to accept that. Yeah.
Well, somebody has to sell the products to those mum and pop shops, so that's where all the money is probably being made. Let me just come to actually something that Sasha said. Now, Jim is going to find it very hard to believe that I was actually a terrible student at school. My teachers absolutely hated me because I was so rebellious. Doesn't sound like me at all, does it, Jim? No. And when I was studying for my qualifications at the Securities Institute, the Australian Financial Markets Association, I remember them talking to me about diversity. Right, diversify your portfolio, right, because your winning stocks can offset your losing stocks. And I was like, but that means that my losing stocks are offsetting my winning stocks. That's a terrible thing.
Both ways, yes.
And so, for some bizarre reason, they would never allow me to be an advisor for the banks. And I walk into the trading room, and I said to the boss, "Hey, look, I've got all my qualifications. I'm going over there. I'm going to sit down on the stock trading desk. I'm going to be a stockbroker. I'm ready to go." And him and like three of the other owners of the company came over and said, "Get over here. You're not going anywhere near the stock trading desk. You're a bloody cowboy. Go onto the futures and commodities desk because you can go and take risks and be a maniac over there." And it was the best thing that ever happened to me because I actually learned how to trade properly. And they were absolutely right, because I would look at what the stock guys were doing and what they were telling their clients, and I'd look at the position. I'd be like, "This makes no sense," because they're like, "But it's a beautifully diversified portfolio." I'm like, "Well, just go and buy the All Ordinaries," which is our equivalent of the S&P 500. Well, like, I don't get it. I don't understand this. So that to me has never made an awful lot of sense. I think that people.
Would you agree that diversify should be replaced with diversify?
Probably, yeah. Look, I think that people can pick individual stocks, but they need to kind of have an idea what they're doing. And I really got to come back to, if you want to be lazy, which is what I'm being these days, I'm pretty lazy about stuff. I can't be bothered half the time. So I'll get a report, I'll get a structured product, or I'll get an ETF or something, and I'll go, "Okay, what are you doing?" "All right, you're doing this sector." And then I'll have a look at something else, go, "That sector's going to outperform that sector. I'm not going to bother with individual positions. I'll buy you, I'll sell you. Bang, I'll do a spread, ready to go." Like the thing about it is, if you wanted to be a really good trader, and then you're sitting with you got an account, you got 10 grand, 20 grand, something like that, you can't very easily go and trade the sorts of positions that the institutional guys and the bigger traders like myself would be able to do, because it's very hard for you to go and buy 300 stocks at a time and sell 300. It's very hard to do that. But the things have changed so much now. You've got access to so much more information. ETFs are fantastic because you get the wide market exposure. Like, there are so many more trading opportunities there. And I said this with emerging market debt. Whilst I probably could go and get it, I'm probably going to struggle to get the kind of exposure I'd want to have. Get an ETF, they'll do it for me. No problems, right? The tech sector. I really am going to struggle to pick one tech company versus another to work out which one's going to outperform the other. But a broad-based tech ETF, cool. I'm going to go and do that. Now, Jim probably will outtrade me when it comes to the tech sector. I would dare suggest that when it comes to banking and insurance, I'm going to outtrade Jim because I know that stuff. The one thing I'll say, unless somebody else wants to jump in, the one thing I'll say about human nature is we have this tendency. You just talked to Milan about, sell puts, or buy the S&P 500, sell calls against it until you're assigned, then sell puts against it until you're assigned on that, et cetera, et cetera. Strategies like that are really simple and they work generally pretty well, right? I've got certain strategies that I use, and I recognize that they have got some flaws and drawbacks, but I've become very stubborn and obstinate about certain things. Now, in some ways, that's to my detriment because it means that I haven't pursued other opportunities like tech, crypto, and all those sorts of things that people are making money out of. But in other ways, it's saved me. It's saved me because I know what I'm doing. I've been doing it for 20 years. I've been making money from doing this for, 15, 20 years. I sort of slightly adjust and hone in my strategies, but I know what I'm doing, right? What people tend to do is they look at something and they go, this seems too easy. It's boring. This other guy made a really fantastic return on something. Or maybe what I need to do is I need to go and do that other thing. I need to go and learn something else. There must be some secret sauce out there. There is no secret sauce out there. There really isn't. And people say to me, oh, well, if you look at what the JP Morgan traders do, like they have all this inside information and no, they don't. They're a bunch of 28-year-olds that just got out of college that have got massive debts that have been headhunted into their quants and their this and that, and they're trading against the bank's balance sheet. You want to be one of them? No, you don't. Just stick to what you're doing. And if what you're doing is just selling a put and then selling a call and that's working for you, then keep doing it.
Yeah.
What are you looking for? Just keep doing that.
Absolutely, Shaq. The other thing I wanted to say is go ahead, Milan.
60% return. Why would you not want to do that?
Yeah.
You can.
Well, I wouldn't want it. I'd be horrified if I was only making 60%.
You can do better than that in the short run, but not in the long run. Absolutely.
I used to want to have a tax problem. That was my goal. The first, when I was an early investor, one of the things I bought was the only investment guide you will ever need was a book, and it said diversification was rule number 1. So I think we've learned a lot in that time frame. But I wanted to support Milan in this sense, in that part of my allocation, and we're talking about the fund portfolio, not our core portfolio. The fund portfolio is when you can do stuff that you don't have to worry about, whether it's rent money or grocery money or anything like that. It's money you can afford to lose. And so in that, I still have, for 30 years, I've been invested in the Schwab 1000. And I treat that kind of like as a cash. I don't want it in a money market. I'm making more in the Schwab 1000 than I would in a money market. But, it's not invested in the way that I think of investments. And as Milan said, you need to look at your allocation. If the stocks go up, am I invested 70% in stocks now and only 30% in cash or cash equivalents? Or is it gotten to 80%? So maybe I should take a look at that. That's what, take a periodic, and not every day, but periodic look at that and see if that's comfortable for you. So stick with what you know and stay within, know yourself. So it's what you're comfortable with. If you're comfortable with more risk, take more risk. If what you're doing is working, don't let anybody else tell you to do something else. If it works for you, keep doing it.
I make 3 statements about fund portfolios. Number 1 is nobody needs it. Number 2 is if you're going to have one, make sure that it's sufficiently small that if you lose it entirely, you don't have to change your lifestyle. And number 3 is the most important of all. Don't keep records because you're sure to be disappointed.
Milan,
Well, while he takes that call, let me just say a couple of things. Sorry, Sasha, you go.
I just want to mention to what Milan just said. Number 1, I had a small fund account. Okay, I had small, but then when it grew about 300%, I took away money that I initially invested out, and now I'm taking house money. But it's not getting smaller because of that. Actually, it's already made up. All the money that I withdrew from the account, it's already made up. Now, about statement. Sometimes I look at the statement not because I need to look at the statement, because simply sometimes it's on my screen. So if it's on screen, what are you going to do? Go blind or something? No, of course, I'm looking at my statement and I enjoy looking at my statement.
Yeah.
So, it's various. But Shaquille, please.
So I'll just say this. I've got an account. It's a sub-account for my main account that's got some money in it. And I basically call it my gambling account or my boredom account, right? There's not a great deal of money there, but it's so that, and I shouldn't do it, but I know me. I know what I'm like, right? So, if you remember Sasha and I'm sitting there, and, it's the middle of the night. Don't forget, for me, the market's open at 1 o'clock in the morning for me. You know what I mean? So I'm bored. It's the middle of the night. What am I going to do? And I remember looking at the Russian rubles before the Ukraine-Russia situation. I'm like, okay, that looks like I'll just put a little trade on that. You're just mucking around, It's just funny to see these exotic currencies sitting in your account. So if you're going to do that, if you know yourself, then just do that kind of stuff. I mean, I think that's I think that's important. There was something else that somebody said that I wanted to respond to, and I've forgotten what it was. It was something that you said, I think, Jim.
Typical.
Yeah. Oh, yeah, no, that was right. Sorry, returns. That's what it was. So people look at returns and they think, well, how much can you realistically make? Okay. And if people hear my returns and they go, oh, that's just outrageously big and all that sort of stuff, I'm like, okay, first of all, I'm not managing billions of dollars, right? I would never able to make those sorts of returns when I was managing large sums of money. I could do it on my own account because I've got no requirements to clients. I don't have to ring the client and go, hey, look, your account's down 40%, have the client freak out, because it's my money. I'll do whatever the hell I want. And I'm comfortable enough to not freak out when my position's down like that.
Shaquille, you are the only client. There's no
I am the only client, yeah. But one of the things that I would say is that people often, I think, have a misconception about the world, right? Bernie Madoff, forget about the fact he was running a Ponzi scheme for a moment. What was the returns that he was promising his clients?
30%.
No, 15. It was 15% per annum. That's all he was offering.
Oh.
Right? So if you have a look at like private equity, the groups that I will say that in some limited cases they do a good thing, and in some cases they make companies more efficient and all that sort of stuff. But for the most part, private equity is just a bunch of psychos, right? Now, but what is the return, right? Because I thought if I can't join them, if I can't beat them, I'll join. I want to see what they're doing. You're talking about like annualized 25% returns. If you look at the hedge fund industry, if you have a look at like the top traders in the world, they're all getting returns in that sort of 20 to 30% range. You have a look at long-term capital management. They had some really blisteringly high returns. They were up at the sort of 40% mark for a couple of years already at 20, 25%. Right? You look at Jim Simmons, who's somebody that I really idolize as being one of the greatest traders ever, and what he did with quant analysis. His returns were between that sort of 25 and 40% range. So people are not making these mega returns that in the professional space. Some people can make them. Like somebody like myself can have a year where I make 100 or 200% on my account. But I'm trading all the time, and I don't have the issues that the big guys have got, because you can place a trade for a few $1 million and get in and out of the market. You can't place a trade for a few $1 billion and get in and out of the market very easily. So I just think people should remember that, because they seem to think that there's some sort of magic formula out there, and there's this secret information out there that if they knew, they too could be JP Morgan himself and start their own bank. It doesn't work like that. You're not going to make that sort of money. Nobody's making that sort of money. And if you are trying to beat the markets and have those supersized returns, one, you're going to have to understand that this needs to not just be a job. It's going to have to be your life. You're going to need to be someone like me who for fun goes and reads the tax code, who for fun goes and reads the annual reports and reads the reports coming out of the Bank of International Settlements and the Fed reports, et cetera, et cetera. I do that because I enjoy it. So unless you're a moron like me and you're going to enjoy that stuff, you're not going to be able to make those sorts of returns. That's the first thing. And secondly, you don't have the time. This is not real life. So what you end up doing is you take way more risks than you should. You blow yourself up, and then you go, "Oh, it's a tough racket, that stock trading." No, you've done it wrong.
Shaquille, I have to teach you just a little bit, because I was listening to you and everything. Or you can be literally, because this is the reason that there was a success here in Durham, and unfortunately it failed. And I've talked about it on your show before, Sasha, and everything. But there was a Black Wall Street, and one of the reasons, and the founders of the Black Wall Street was literally the barber of the robber baron. So everybody knows that I even one myself now, a beard cut, if not a haircut and everything. But he got was able to create a black mecca of financial society in one of the Black Wall Streets and everything, because he literally was Mr. Duke's barber. And while he was Mr. Duke's barber, I'm sure he was also cutting the hair of like the other people like the Vanderbilts and others that might have been coming to Durham. So he was learning because he was doing a service trade, and while he was cutting his hair, he was hearing these business deals, and even Mr. Duke himself gave advice and invested into the Black Wall Street and everything. So he actually learned at the feet while doing a service job and everything. So sometimes people are paying closer attention than we think they are, and that's the way that you can be a successful person, because he literally was one of the founders of one of the major insurance companies, North Carolina Mutual, that existed for 100+ years and everything. But he got those skills from learning as he was cutting the hair of Mr. Duke.
People should pay attention to taxes. People should pay attention to also government subsidies. So some companies will benefit. And people talk about, Tesla and Oracle and all these companies have moved out of California because California is full of these left-wing liberal communists. But yeah, on the other hand, what California does is actually invests in certain companies. And so those companies that benefit from it can actually do very well in California, right? And this is why I think Californians have a right to be a little bit annoyed with Elon Musk, because California helped to build Tesla up.
Absolutely.
And then he's like, well, I don't agree with your politics. Okay, well, then you should have started up there, dude. Like, it's, I think California's got it right. But the point is, if you're looking at a startup and you look at what sort of government funding they're going to get, you can look at that and say, well, actually, I think I might invest in that company that's domiciled in California as opposed to Texas, because California is less likely to want to see that company fail. So you make all these sorts of assessments, but most people don't have time to do that. So don't try to reinvent the wheel. Trading doesn't have to be complicated. People make it complicated because they think that there's some sort of secret sauce out there. There isn't.
Yeah, and a 20% return over 20 years adds up. This is the thing. And I think that by sticking to what you know and being disciplined, and but I do want to tell you, the last time that I invested from the market was right before the .com bubble burst, and the reason was, and this is going to the kind of the listening to somebody else talk. I was at lunch. I live right by Stanford University, and so there was a Stanford student telling his date about his launch, and it reminded me of the old story of in the 20s. The guy saying when his taxi driver started talking to his about his portfolio, I knew it was time to get out. Yeah. It was like, it's when these people were talking about his launch, it just triggered me that everybody that was throwing money at anything.com, this was crazy. So I got out of a lot of the stocks, and I had a lot of .com stocks, and it was just a few months and the market tanked. But I tell this story on myself too, because I don't want to brag. One of the things I did was buy some corporate bonds, including one that no longer with us, Lehman Brothers.
Yeah. Lehman Brothers.
Did Michael Milken sell them to you?
I thought it was too big.
But bond investing is a very interesting thing as well, because you can structure a portfolio reasonably well. And I think that this is actually the part of the market that I think people, it's actually accessible to people, but it's such a learning curve that nobody gets involved in debt trading. And if you actually look at it, I would argue that the debt market is actually bigger than the FX market. Everybody says the FX market transacts, 3 to 5 trillion a day. And well, I would say the debt markets do as well, but it's in notional value. You can't access bank swaps and stuff like that unless you're actually a bank or a financial institution. But you can easily trade the spreads, notes over bonds, and all that sort of stuff, the 2-year versus 5-year and all that. It's very easy. There's massive liquidity. I mean, massive liquidity. Yeah. It's far more than if all four of us were to liquidate everything we've got and try and leverage it up to the max and put a position on, wouldn't even touch the market. So great opportunities there. And nobody ever really does it. That's one of the reasons why I do it, because I was looking for something else that, had the liquidity, and where perhaps I could have an edge over my competitors in trying to attract corporate money. And I just happened to be better at that than I was at anything else. But
I don't know what you think about this, but a lot of grandmasters that I knew started currency trading. So it sounded like for the same kind of reasons, debt trading.
And a lot of them were very good at it, by the way.
Absolutely.
I think you learn a lot about people based on how they play chess, right? Like if you've never seen me play chess, Sasha has, and I'm not going to. I'm actually putting words. That's all I need. I'm going to put words into Sasha's mouth because this is not what he said, but I'm going to assume that Sasha has sort of said stuff like this to me, but he's going to look at me and go, right, you're very aggressive, which I am. I'm an extremely aggressive player. But as I've openly said, I do try to look for moves that the other people are not going to expect. So much better players than me do have a couple of weaknesses in that they know the perfect lines really well. So what I'm going to do is I'm going to try and find a move which is actually not that perfect, but it's unusual. And so it's going to make them go, whoa, what do I do with this?
You're preaching to the choir.
Yeah. So, and I've had some success doing that. But that's something that when I watch people play chess, even if they're not very good at chess, right? They can watch. Is that a book you've written? Is it a book you've written that I don't own?
A friend of mine has written. Two friends of mine co-authored the Norwegian Rat. So
I'll have to get it.
Yeah, it's a wonderful book, and I've been playing it against strong players, and they're just not booked up on it. So you get
so I look at people that are weaker than me, and I see what they're doing, and I think I can kind of judge people in much the same way as I'm sure you guys that are much better than me would judge me. You can tell when it's just that I don't have the knowledge, but you can probably tell what I was trying to do. Like what's the essence of the style of play that I'm trying to actually put out there. And you learn a lot about a person's personality and what they're doing.
Totally agree.
That's how I trade the markets. I personally think that chess players would make pretty good traders for specifically that reason, because in the pursuit of perfection, you can't trade like a computer. You can't play chess like a computer. And would you even want to? Maybe you would. I don't know. But you can't play chess like AlphaZero. Nobody's going to be able to do that. But when you're playing as a human being against another human being, you can. It's not just about the chess moves. If you both are at the same level of chess play, it's almost like a poker game. It's about bluffing people. It's about, I've often found that the threat of the move is often way more important than the move itself, because a person might waste 3 or 4 moves dealing with the threat, and meanwhile you're developing something else. So it's a mind game more than just strategy.
We're far afield from investing, but I try to tell people this: when you have a couple of masters spending 4 hours over the board concentrating, not exchanging a word, you know each other when you get up from the board. You can, if you're going to be friends or not. It's like
I'd like to, before we finish today's program, I'd like to though make a statement that there are a lot of traits that are very similar in grandmasters, chess players, and top traders.
Yes,
a lot.
I agree.
One of them is intuition. Another one is recognition of patterns.
Yep,
because both patterns recognition is a great role in both chess and as stock or futures trading or anything like that.
Absolutely.
And finally, you remember there was a great American grandmaster, Reuben Fine.
Yes.
He had fantastic technique and he was meticulous. And on the other hand, there was a great chess player, world champion, Michael Tal, who was a genius of combinations and tactician and so on. And the saying goes like this: you can learn a lot from Reuben Fine's game,
Yes.
but not particularly very enjoyable exercise. Now, on the other hand, from Tal's game, you can enjoy them. They're fantastic.
Yes,
they're
they're
beautiful.
hard work.
But there is nothing you can learn
You
because
can't do it.
how can you learn something that the nature didn't gift you? You just didn't have a gift similar to Tal. So therefore, just enjoy the games. Don't try to learn anything from Tal's game.
We need to talk about the role of luck in life and in investing. So maybe at our next Wednesday we can discuss luck, because it is a very important role.
That's a great topic, Milan.
I have to tell you, though, it is so much fun. You go to chess.com, you can actually play Mikhail Tal's games, and you're here, but it corrects you if you've made the wrong move. And there is something that is just so magnificently beautiful about sacrificing your queen for some random reason, and then 3 moves later you've checkmated someone. Like it's one of those things that I have to say I've learned a lot about. Like using a piece to be a magnet for another piece. You force the piece over here. That it's a very aggressive style. I wish that I could have seen him in real life play chess, because I think his games were amazing.
Oh, they were, and but also there are people like Jacopo Rubinstein, and he was a technician as well as a brilliant tactician. So there's some people that have that combined. It's wonderful to play over his.
If he would ever play the match in Lasker, he could beat him. And not always, but in some.
We all thought that before the World War I broke out that he was going to be.
Before World War I. Okay, gentlemen, I thank you so much for today's show. I think we had fun, and looking forward to see you next Wednesday, same place, same time. And Shakil, get ready for tomorrow's debate. Okay.
It depends on what the fact checks are. I think we should let our audience here know what the conversation is going to be about tomorrow. We were talking about trickle down economics versus more government expenditure, and I think Sasha might have been slightly surprised that I'm not as opposed to government expenditure as what it might sound like because of some of the things that I've said.
Your words come back to haunt you.
And what you might be most surprised about, which I think will be very amusing for many of the audience members and perhaps guests here to actually watch, is the extreme right-wing, low government person, the small government person that I am. I actually quite like Sweden. I'd happily live in Sweden and use their tax code very happily. So that'll be a very interesting conversation on World Edition tomorrow. So I'm looking forward to that.
Thank you so much. Bye-bye, everybody.
Bye-bye.
Have a good luck in investing and everything.
Cheers.
Bye-bye.